Okay. Good morning, everyone, and thank you for joining us today. My name is Thomas Stavridis, and I'm here with my teammates Petrus and Anele, and we are going to be presenting our project on our pairs trading strategy. Over the next couple minutes, we're going to take you through our approach to pairs trading, our investment philosophy, and the framework we developed for implementing the strategy. Pairs trading is a market neutral strategy that allows us to profit from price movements of related assets. To bring the concept to life, we use real world data from stocks like Apple and Shell, designing a systematic approach that blends quantitative analysis with practical risk management. And let's dive in by understanding the foundational concept of pairs trading first. So, what is pairs trading? So, pairs trading is a strategy that exploits the historical relationships between two correlated assets. When these assets deviate from their usual relationships, we take a long position in underperforming stock and a short position in the outperforming stock. For example, if Apple and Shell, two companies in very different industries, but historically correlated price movements diverge, we assume that the prices will eventually converge, and this creates an opportunity to profit. What makes pairs trading unique is that it's market neutral. This means that instead of predicting market direction, we focus on the relative performance of the paired assets, reducing exposure to broad market trends. And now that we understand the concept, let's discuss the broader vision and objectives of our project. So, our future vision and our objectives. So, our vision for the project was to create a scalable and efficient framework that capitalizes on principles of pairs trading. We aim to design a system that works across different market conditions and minimize human biases. So here are our key objectives. So we optimize the pair selection using statistical methods such as correlation coefficient to identify pairs with strong historical relationships. Real world testing, which is applying the methodology to high profile stocks like Apple and Shell, um, to validate the strategy. Minimize risk, setting a maximum holding period and limiting exposure through the diversification and leverage controls, and then efficiency and automation, implementing a systemic framework for a weekly trading frequency, ensuring consistency. And this vision aligns with the core principles of our investment philosophy, which I'll now explain. So the guiding principles of our investment philosophy is built around three guiding principles. So market neutrality is the first one. By balancing long and short positions, we minimize exposure to overall market movements. This ensures we're less affected by events like market crashes or rallies. Number two is data-driven decisions. We rely on quantitative metrics such as historical correlations, rolling averages, and spread analyses to make informed decisions. And then the third one is our risk management. From imposing strict entry and exit criteria to limiting holding periods, we prioritize risk mitigation at every step. And these principles shape the investment strategy you'll see next, driving everything from the stock selection to the trade execution. So then let's break down the strategy. So we looked at the universe selection. So we began by filtering stocks based on factors like liquidity, fundamentals, and market presence. This allowed us to focus on highly traded and reliable assets such as Apple and Shell. We also looked at the pair formation using historical price data. We calculated correlation coefficients to identify pairs with the strongest relationships. And then we looked at the trade entry, which like basically once a pair's price spread deviated significantly, we entered trades. For example, if Apple's price rose unexpectedly compared to Shell's, we short Apple and then go long on Shell, assuming reversion. And then our trade exit, we monitor trades closely and exiting positions when the spread reverted to mean or when the maximum holding period was reached. And the systemic approach ensured consistency while minimizing emotional decision making. To make this, yeah, and that was basically just to make all that clear. And now I'm going to be handing you off to Petrus, who is going to continue with the next couple slides.
Welcome. So, as Thomas said, today I'll present a pairs trading strategy implemented in Quant Connect's framework. Our code systematically changes trading periods, selects a universe of stocks, forms pairs based on correlation, and enters or exits trades depending on spread behavior. Let's begin with how we set up different backtest periods. We define our time periods based on multiple date ranges in a dictionary. By changing self-time period, we dynamically run separate backtests for each period without modifying the entire code. In regards to our cache and universe settings, we set our initial capital and add a benchmark asset for daily resolution. In this case, our initial capital is 100,000 US dollars, and our benchmark asset is the SPY. Some key parameters that I should mention are our self period, which equals to 52, for the rolling window size, which is about a year of weekly data. We have the self-holding and period limit, which is about 26 for half of the weeks in a year. And this restricts how long we can hold an open pair. We have the self-leverage, which equals 5, to potentially magnify returns and risk. And then we finally have self-max traded pairs, which equals 5. And this ensures we only maintain a handful of pair trades at a time. Next, we will look at how the code selects stocks and stores their rolling price data. So for the fundamental selection, we add a universe selection function, which runs weekly. Inside fundamental selection function, we filter US stocks, a minimum share price, and robust fundamental data. We then sort by dollar volume and pick the top 500 to ensure liquidity. In regards to rolling windows, for each stock symbol, we maintain a rolling window of length self period 52. This rolling window holds the most recent price history. When new securities are selected, the algorithm downloads historical data, which is in the self history function, and fills the rolling window with daily close prices. Only symbols with a full 52 days of price data are retained in the final universe for correlation checks. With the universe in place, we form pairs by calculating correlations. On securities changed, whenever securities are added or removed from the universe, we update self-history price accordingly. We create all possible pairs from the currently selected symbols. For each pair, we compute a correlation using a custom function correlation, which nominates each price series against its latest price. We select the correlation values in a dictionary, then pick up the top 20 most highly correlated pairs. These pairs get saved into self-sorted pairs. So you may be asking, why correlation? Well, if two symbols have historically moved in sync, the strategy assumes any temporary divergence in their normalized spread will eventually revert. Next is where the real trading behavior happens on data. The algorithm checks all currently active trades in self-traded pairs. For each active pair, it calculates the normalized spread, which is price series normalized by their most recent price. It checks if the spread has reverted to within one standard deviation from its mean. If yes, or if the holding period limit is exceeded, it liquidates both positions. On the new entry side, if we have fewer than self-max traded pairs as active pairs, the algorithm attempts to open new positions from the top correlated pairs. The enter pair trade checks the spread again. If the spread is more than 2 standard deviations away from its mean, the strategy triggers a mean reversion trade. If spread is high, short the expensive symbol and go long the cheap one. In contrast, if spread is low, do the opposite. The code allocates capital per pair to maintain a market neutral approach. With the liquidation side, when a pair reverts or times out, the strategy calls liquidate pair to close both legs. So, to summarize, we picked an isolated backtest period. We filter a universe of stocks and keep rolling windows of their prices. We form pairs by correlation. We trade on significant spread divergences, expecting mean reversion. The script modularly backtests multiple date ranges and logs everything for deeper analysis. I will now turn it over to Anele for further explanation.
Now, moving on to our backtesting and the results, starting from our first period, which is the 2010 to 2012 period, which is the first period we analyzed for our backtesting results is split into 2010 to 2012, which is our post-financial crisis recovery period. We have 2013 to 2015, which represented a relative stability within our strategy implementation. We have 2016 to 2018, and then 2019, 2021, and 2022 to 2023, which is also which is also our pandemic period. Starting from the beginning, this period occurred during the aftermath of the 2008 financial crisis, a time when markets were experiencing high volatility and significant trending behavior. The strategy struggled during these years because it relies heavily on mean reverting patterns, which were scarce in this environment. While the initial performance suggested some promise, it quickly became apparent that the pairs selected were diverging further rather than reverting. This led to a sharp drawdown, severely depleting the portfolio's value. One of the major issues was the lack of robust risk management, particularly for highly volatile periods. This highlighted the importance of adapting the strategy to handle markets when mean reversion is unreliable or correlations break down. And this is reinforced looking at our equity analysis. We see that the equity curve shows an initial rise followed by a sharp and sustained decline, leading to significant portfolio erosion. We see that from around July of 2020 all the way down to July of 2021. The strategy struggled in a volatile post-crisis recovery environment, likely due to diverging pair correlations and high market volatility. Moving on to our next period, which represented our more stable period amongst all of our periods when we did the backtesting. The 2013 to 2015 period was a turning point for the strategy. Market conditions were much more stable, with less extreme volatility and stronger mean reverting behavior. This provided the algorithm an opportunity to perform well, achieving a net profit of 54.417% and a compounding annual return of over 15%. These results show that the strategy thrives when its core assumptions about correlated pairs hold true. However, the analysis revealed missed opportunities due to inefficiencies in trade execution and suboptimal timing of entries and exits. While the results were encouraging, it became clear that future refinement to the algorithm could enhance its ability to capitalize and profit more on these opportunities. Looking at our equity analysis curve, the equity curve exhibits steady upward trends with periodic fluctuations, reflecting a more stable performance. The period aligns with market conditions conducive to mean reverting strategies as the portfolio steadily grows with more moderate drawdowns. And we see as we look at the curve, some fluctuations, but overall there's a steady increase, except towards the end of 2015, going into 2016, we do see that a sharp decline, but overall steadiness. Overall, there's a general increase in the climb of the return that we're receiving. Looking at our 2016 to 2018 period, this period represented a mix of challenges and successes for the strategy. The market exhibited sporadic volatility, making it more difficult to identify reliable pairs. While the strategy showed some improvement in profitability metrics, such as slightly better profit-loss ratio, high drawdowns continue to be a significant issue. The portfolio's performance was inconsistent, suggesting that the strategy struggled to adapt to rapidly changing market conditions. The period highlighted the importance of refining the pair selection process and incorporating dynamic risk management measures to respond more effectively to shifting market behaviors. And this was prevalent through all our periods. The need for more assertive and more proficient risk management techniques in order to minimize our losses and maximize our gains. Looking at the equity analysis curve, we see that it's relatively flat for most of the period, with a severe drawdown towards the end, erasing all prior gains that we had. The sharp decline highlights issues with the risk management and strategy adaptability to changing market conditions. And this is a prevalent issue through most of our periods, if not all, the issues of risk management and adaptability. Moving into the next period, which is our pandemic-driven period, this is the period before and during COVID. We see that this period was dominated by unprecedented volatility due to the global COVID-19 pandemic. This was one of the most challenging environments for the strategy, as markets were unpredictable and often driven by external shocks. The algorithm faced significant difficulties in maintaining performance, leading to an alarming drawdown of 83.5%. While there were some positives, such as favorable profit-loss ratio, indicating that winning trades were more profitable than losing ones, the low win rate and persistent losses made it impossible for the portfolio to recover. This period highlighted the need for greater adaptability in the strategy, particularly during periods of extreme market stress, and highlighted the importance of incorporating mechanisms to mitigate the risk during such said events. And of course, this leads into our risk management and adaptability of the portfolio. During times when our code was not most conducive to the environment, it struggled heavily to adapt and pick correct pairs in order to maximize on profitability and minimize on losses. And unfortunately, our code is struggled heavily during this time, and the losses were so bad it completely negated all prior gains that we had made. And this is made evident if you look at our equity analysis curve. The 2019 to 2021 period highlights significant challenges faced by a strategy. The portfolio initially maintained a stable performance, but experienced a sharp and prolonged decline in equity during 2020, likely reflecting the volatility and market shocks caused by the pandemic. This severe drawdown eroded majority of the portfolio's value, and despite minor stabilization in 2021, the equity failed to recover meaningfully. The graph illustrates the strategy's inability to adapt to extreme market conditions, emphasizing the need for better risk management and greater adaptability in volatile environments. Looking into our last period, which is the 2022 to 2023 period, which is semi-post-COVID. This period reflected ongoing challenges as markets adjusted to the post-pandemic environment. Despite some stabilization in the equity curve, the portfolio suffered a significant net loss of 57.423%, with a compounding annual return of negative 34.825%. The strategy's win rate dropped to 34%, while drawdowns remained substantial at 63.2%, pointing to persistent issues in pair selection and trade execution. These results emphasize the critical need for refining entry and exit logic to improve the win rate and reduce losses. Furthermore, the strategy must evolve to better navigate dynamic and shifting market environment as it struggles to align with post-pandemic conditions effectively, and just generally all times of volatility in the market, our algorithm struggled to adapt. Looking at the equity analysis, we see that the equity graph for 2022 to 2023 period highlights severe underperformance by the strategy. The portfolio experienced a sharp and sustained decline in the first half of 2022, leading to significant losses. While the equity stabilized somewhat in the later part of 2022 and throughout 2023, there was no meaningful recovery in the portfolio value. The flat performance in the latter stages indicates a lack of adaptability to prevailing market conditions, reflecting the strategy's difficulty in generating profitable trades and recovering from initial drawdowns. The graph underscores the need for better risk management and enhanced strategy flexibility to navigate such adverse market environments effectively. In conclusion, looking at our key takeaways, we had a systemic approach. We implemented a data-driven algorithm for pairs trading. We leveraged correlation metrics and statistical analysis to form robust trading pairs. The innovations that we made, we changed it from daily to weekly trading frequency to reduce our cost of transaction every time we sold and bought stocks, for operational efficiency, maximum holding period to mitigate risks, and we have custom filters to refine the stock universe based on fundamentals and liquidity. The trading logic and adaptive spread-based entry and exit rules, maintain market neutrality while exploiting statistical relationships, what we attempted to do. It was designed for scalability with leverage and multi-pair handling, and we prioritize liquidity and risk management for consistent performance. However, it was shown to us that this was a significant issue, as during volatile times in the market, our algorithms struggled to mitigate losses, struggled to minimize or maximize our gains. So in closing, looking across all 5 periods, the results tell us a consistent story. The strategy performs well when market conditions align with its assumptions, but falters during periods of high volatility or extreme trending behavior. The key lesson from these backtests are the importance of robust risk management, effective pair selection, and adaptability to market conditions. Refining these aspects of the strategy would significantly enhance its performance and resilience. These findings not only highlight areas for improvement, but also reinforce the value of iterative development and continuous testing in building effective trading systems. All in all, with more work, our algorithm could perform better, especially during those more volatile markets, and there's always room for improvement. Thank you for listening to our presentation. We hope you took something away from. We hope you enjoyed it. Thank you.